Inflation in Singapore is expected to be higher than previously forecast amid conflict in the Middle East. The Monetary Authority of Singapore bracing for impact, tightening monetary policy settings for the first time in over 3 years. At the same time, new GDP figures show the economy unexpectedly slowed at the start of the year. Beatrice Yap with this report.
Singapore could be in for another round of rising prices, driven by higher global energy prices. Inflation warning bells are ringing, with the MAS raising forecasts for 2026 to an average of 1.5 to 2.5%, up from 1 to 2%.
Our base case is still that it is not as bad as COVID, because on the demand side, this time is less clear that there will be so-called pent-up demand. If anything, I think there could be a sticker shock instead, a cost of living shock for households globally, not just in Singapore.
MAS projects inflation should ease progressively by 2027, but only if energy supply disruptions fade. Until then, imported cost pressures loom large. To blunt the shock, the central bank has tightened monetary policy by steepening the Sing dollar's path of appreciation. But the effects may not be reflected so soon.
It may take time to pass through due to existing arrangements and contracts and so on and so forth. But MAS models indicate that the peak impact of monetary policy tightening on inflation will usually be after 4 to 6 quarters.
The inflation outlook is only one side of the story. Growth is now also coming into focus. Advanced GDP estimates for the first quarter put growth at 4.6% year-on-year, well below market hopes where economists had penciled in nearly 6% growth. The shortfall flags mounting headwinds from costlier energy and disrupted trade routes.
I think the outlook is for the economy to slow down further because of some potential downside risks from the lack of inputs that could and the disruptions, which could then cause some of the activity levels to drop, and also from a potential broad slowdown among Singapore's major trade partners. So this may materialize in the coming few quarters of the year.
Energy-hungry sectors like petrochemicals and transport could face the hardest squeeze. Still, parts of the economy remain resilient.
Domestic-based services as well as construction continues to be quite buoyant. Some of these are anchored by long-term projects. At the same time, the AI-related demand continues to grow fairly healthily, which implies a demand for some of the electronics items that Singapore has been producing and exporting.
Singapore's economy is forecast to grow 2 to 4% this year, but the Trade and Industry Ministry warns the conflict could weigh on activity ahead. An updated full-year GDP outlook will be released in May.
And for more analysis, we're joined by Chua Han Ting, who is senior economist at DBS Bank. Now, Han Ting, MAS is warning of global supply shocks that could slow growth and also push inflation higher. How should all of us as Singaporeans understand what's coming?
Thank you for having me. So I think we are living in a highly uncertain and volatile global landscape. Global shocks are becoming more frequent, such as those from the Middle East conflict, and they will and are permeating through Singapore's highly open economy. What is already here is the impact of higher inflation, and that means higher cost of living. Singaporeans are already feeling this through higher pump prices, higher electricity and gas prices, airfares, as well as I think the delivery costs in Singapore are also going up. Singapore's economy is confronting the Middle East shock from a position of strength, but I guess there are growth challenges in the coming quarters down the line.
Now, despite that position of strength, as you say, we're looking at a triple whammy here. There's slower growth, there's also rising energy costs, and then higher inflation expectations. What does this mean for both jobs and incomes? And could these cost pressures spread even further across the economy?
I think what we are seeing right now from the Middle East conflict is a significant energy price shock. And what this means for businesses is that their operating costs will increase and perhaps with some pressures on their revenues as well if external demand weakens. So this would mean that their profitability would come under pressure, and globally that might mean a cutback in capital expenditures. And what this means is that businesses in Singapore might become more prudent and be more prudent in terms of manpowering, hiring, or in fact, wage increments. And if you do turn back into inflation, how might these cost pressures spread further across the economy? I think one of which is that the Middle East war is not just about energy, but there are other disruptions like fertilizers. So if higher fertilizer prices reduce their usage, that would result in lower crop yields and therefore lead to higher agricultural prices and increased food inflation globally and Singapore as the year progresses.
And speaking of inflation, that's now forecast at 1.5 to 2.5%. Can measures like vouchers and rebates meaningfully ease the pressure on households?
So Singaporeans will receive U-Save rebates, as well as I think there's been announcement on CDC vouchers being brought forward, as well as enhanced cost of living special payment. And I think that would provide a direct and targeted financial relief for households to sort of offset their higher daily expenses and alleviate some of these upside cost pressures. I think that is why the government announced some of these policies around this just last week. I think the government has quite ample fiscal space for further support if needed.
And speaking of that support as well, to help to tackle the rising cost of living, do you think the current conditions now justify additional fiscal support?
In fact, I think the government in its nearly Singapore dollars 1 billion support package announced last week likely accounted for the current economic conditions and forecasts for the year that therefore include some of these cost of living relief that was being announced. I think ultimately this is being complemented by today's monetary policy decision by MAS. They guided for a faster appreciation of the Singapore dollar nominal effective exchange rate policy band slope in light of the higher inflation environment that we are likely to face.
Han Ting, thank you so much for sharing your insights with us. That was Chua Han Ting, who is a senior economist at DBS Bank.